Hey, it's Craig back with another Mortgage Minute, and today we're going to talk about the Fed rate increases and how if you're in the market to buy a home right now, that's actually a good thing for you. And I know that sounds crazy, but just hear me out for a second. So you may have heard in the news that the Fed is going to continue to increase interest rates. And a lot of times when people hear that, they confuse that with mortgage rates going up. And actually, they're two different things. Okay. So let me tell you what the Fed is trying to do. And then let me tell you how mortgage rates can actually positively benefit from that. So when the Fed increases interest rates, they're actually increasing the Fed funds rate, which is not mortgage rates. Okay. These are rates more on credit cards, car loans, maybe home equity lines of credit. Okay. And really, the goal of the rate increases is to slow the economy down. Now, you may think, why would they want to slow down the economy? Isn't a good economy a good thing? And, generally speaking, yes, a good economy is a good thing, but it can be too much of a good thing. And if that's the case, you start to have inflation concerns. And you've probably heard that word, right? I mean, I think everybody's aware now that there's inflation that it's going on. If you've been to a gas pump lately, or if you've been to a grocery store, you realize that things cost more now than what we're used to paying for them in years past. And, you know, a little bit of inflation is pretty typical, right? Year after year. But the amount of inflation we've had the past couple of years is not typical. So what the Fed's trying to do is they're trying to slow down inflation. One way to do that is to increase the cost of borrowing money. Maybe that stops people from spending as much money. So just for example, let's take car loans for example. If the cost of a car payment is going to be higher because the interest rate on that car loan is going to be higher, maybe that causes less people to want to buy a new car. Okay, that starts to slow the economy down. But the key that the Fed is really trying to achieve here is they're wanting to slow down inflation. Now, why is that a good thing for mortgage rates? Meaning, why would the Fed wanting to slow down inflation be good for mortgage rates? Here's why. The biggest enemy of mortgage interest rates is inflation. Okay, so if you think about it, if somebody were to give up, say, $200,000 to someone else and make a mortgage to them, okay, doesn't matter if it's a bank or an individual, it's the same concept. And let's say that person's going to get a rate of return of, let's just say 4%. Okay, that means if it's a 30-year fixed rate loan, the person with the money that's loaning the money to the borrower, they're willing to give up their money for 30 years and only get a return of 4%. Okay, now here's the thing. If inflation is high and is thought to continue to increase over those same 30 years, now the person that's loaning the money is looking at it going, well, you know what? I don't know if that 4% is enough of a return given the fact that the cost of goods is going to constantly be increasing. So that same person may come back and say, I really need a rate closer to 5%, or I need a rate closer to 5.5% to make sense for me want to give up my money for that long of a time period. So if the Fed is helping to slow down inflation, now lenders that have money might be more willing to take a little bit less of a return because they're not as concerned about the cost of goods being so high down the road. Now, that's an oversimplification of it, but that is exactly the way it works. So here's the thing. Next time you hear that the Fed is going to be increasing interest rates, if you're in the market to buy a home, think to yourself, oh, you know what? That's actually probably a good thing for mortgage rates. If you have questions about that, let us know. 615-498-5626, and I appreciate you watching.